I've been a buyer of Xerox shares. Now, you may say you're a naughty boy. I'm guilty as charged. I've been buying. Am I a Xerox bull? Let's think about it. To be a Xerox bull of any notable degree, what you really need to do is you need to believe in this combined Xerox Lexmark platform that it can stabilize or even increase core print profits, right? As well as believing in the continued growth story of the IT solution sector. I do believe all that. I believe this for the medium term horizon at the very least. So I guess I'm a bull. Now, a few points of discussion and slides to show you. What we will be discussing is debt. How exciting. We're going to be talking about debt, everyone's favourite subject. We're going to be talking about free cash flow and we'll talk about the reinvention story. So don't worry, I've got you. But as for the multi-year reinvention story or the process of reinvention, it's taking place. Now, in my opinion, it's really at its late stages now. They've pretty much done the bulk of the reinvention story. It's now about seeing results before kicking on with the next leg of the reinvention process, in my opinion, which the next leg will probably be pushing more towards the IT solutions and sector, digital services sector, with further acquisitions. But again, that's some time off. It's down the road. It's going to be a couple of years down the road, perhaps. So let's focus on the here and now. That's what I'm going to zone in on, the here and now. And that's really largely down to the Lexmark acquisition. How exciting. Quite as exciting as the small blue pill exciting, if you know what I mean. But it's definitely encouraging for an investor. It's going to increase free cash flow, right? That's happy days for any investor, and it's immediately accretive. So we don't need to wait for free cash flow to increase. It's already adding to the bottom and top line. And it's predicted to unlock synergies of what they say more than $300 million. More than $300 million. Now, that's what they say. So when companies say stuff about synergies, right, quite often they fall short of their synergy expectations. But nevertheless, it makes sense. Synergies are there to be taken for Xerox. That's without doubt. Synergies just really mean cost savings. You're going to save money. Imagine you've got a mobile phone shop in your town or city. You own that. You own mobile phone shop A. And then you buy another one out. You buy out mobile phone shop B. So phone shop A buys shop B. You've now got one company that you can streamline, right? So you've got um, two sets of sales staff. You've got two buildings. You've got two supply chains. You've got two product lines. You've got two production and storage facilities. But it's only one company. So streamlining is what you would do. That just means you're going to synergize. You're going to save costs. Now, the other acquisition, it's all about IT and digital services. In large part, it's the IT savvy acquisition. They have made other acquisitions as well. You can obviously search for those. Okay. But IT savvy, that's the main one. This part is the future. It's the future of Xerox. IT solutions and digital services, that's the future. They're expanding and pivoting away from the core print segment through to IT solutions and digital services. The IT savvy acquisition being key here, as you can see, it's a growing segment as well, right? It's growing. Now, shareholder value is tangible, firstly through a dividend yield, which they say is in line with the market. It's currently at a touch above 4%, the yield is. Not only this, you've also got debt reduction, which is underway. We'll discuss debt in greater detail later on in this quick presentation. Obviously, other ways to get shareholder value is via our favourite way, stock price appreciation. We are at a very depressed level when it comes to market cap and share price. So I would think it's not too difficult to realise some value at these levels. None of this is investment advice. It's all for entertainment purposes. You've got to remember that when you're listening to some nutter on YouTube talking about stocks and shares. Now, Going back to the reinvention story, you can see the reinvention process in recent years for Xerox has meant that they've been busy bees. They've got rid of a load of overhang, right, for the company in recent years, which is, to be honest, is good news for recent investors. So if you're buying in now, right, it's good that they've done really a lot of the hard graft already. But having said that, it's the recent deals and acquisitions which are accretive and encouraging for me. That's what I really want to zone in on. You can see the marketing deals lately, which should, being the operative word, it should add to sales revenue as well as the bigger stuff of acquisitions. That's what we need to look at, the bigger stuff. Size matters when it comes to these type of things. Lexmark is part of a much expected consolidation of the print industry, and it does help Xerox get hold of the Asia Pacific region, that geography, the APAC geography. Obviously, that's largely for print, but potentially for IT solutions and digital services as well through cross selling into that region. And as they mentioned, Lexmark helps Xerox in the growing A4 print segment. Consolidation is the way for mature industry. Consolidation is it's basically natural for players or in a mature market. Just look at the telecommunications market. Telecommunication companies are doing it all the time. The bigger ones are buying out the smaller ones, or two like-sized ones are joining together because they know it's a difficult industry and it needs consolidation. Now, that's one of the reasons why I've got a buy and hold strategy for the medium term. Xerox could well be bought out itself by another player looking for more consolidation in the print industry. Another possible catalyst, the Trump tariffs. Now, they did impact Xerox. They impacted a number of companies. But if these tariffs are scrapped, for instance, if they reverse through a potential Supreme Court ruling or a Trump backtrack or even a future Democrat reversal, Xerox stands to benefit. So that's a potential catalyst. Now, even if tariffs stand, they do indirectly help Xerox in that the American market would just be a bigger barrier for entry and pricing for Asian print companies because those companies will have to pay a tariff to get into the American market. Of course, the catalyst a company is responsible for is the main one that investors look for. That's the increased earnings. That's really the catalyst that we all really care about, which I expect in 2026, given a full year of Lexmark and more synergies being realized alongside the growth of its IT and digital segment. I expect free cash flow to increase, earnings to increase. As for the bad news, is it all largely behind us now? I know we've had a lot of bad news over the last 12 to 18 months. It's been a rough patch, right? Well, you would think by now, especially with the increased leverage, reduced dividend, tariffs, reduced free cash flow, the shelf offering, and the immense slide in stock price, and you would think all that bad news has been kitchen sink by now. It's hit the market, right? How much more bad news can they put out there, right? That's one way of thinking of it. So it makes it more attractive to buy right now. It's an attractive proposition, in my opinion. None of it's investment advice. It's all for entertainment purposes. Just remember that. But there is obviously the debt overhang, which is the chief worry for investors and potential investors. The total debt, it is quite big. It's currently above 4 billion. Now, it was recently stated it's currently 6.1 times the last 12 months EBITDA. Their aim is now to reduce leverage to 3 times EBITDA. Obviously, synergies, increase free cash flow through Lexmark and IT Savvy. That's all going to help with this endeavour. That's one would think that, right? Alongside what they've already done, a lot of people are forgetting this. They've already cut the dividend drastically, right? So they're saving money there. Now, this is where shareholder value derives from, in my opinion. It's really a case of when a company delevers then the multiple expansion kicks in and stock price appreciation kicks in. Right, just imagine you're an individual, you've got a small business, you've taken out a loan, right? So you're paying the bank, you've got credit cards through the roof, and you've got your mortgage, right? And you're paying that off. You're increasing your wages, right? And you're stashing money in the bank as well whilst doing all that. Your net worth, what's happening with that as you do this? As you delever, so you pay off your debt and you increase your earnings, it's going to increase, your net worth's going to increase, right? That's the way a company with a large burden of debt would operate as well. As it pays off, i.e., as it delevers, right, and increases earnings, the value of that company will increase. It's just natural. It's it's the way finance works. Now you'll see these foolish and trollish type of comments out there about bankruptcy and Xerox going bankrupt. That's not on the horizon, in my opinion, anytime soon. Obviously, anything can happen. You could be hit by a meteor tomorrow. Hopefully, it's not going to happen. But obviously, it's very unlikely. But it could happen, right? But in my opinion, when you look at and research the maturities, it's very unlikely to see a bankruptcy anytime soon for Xerox. The debt maturities for 2026, so this year, and 2027, they're relatively tiny. Relatively tiny. Now, you're looking at, in total, about 350 million. That's not difficult. That's pretty much easy street for Xerox. 2028 and 2029, obviously that could well be quite challenging, but you would think they'd have refinanced in a lower interest environment by then. On top of that, you've got forward payments, you've also got an increased cash position. So given these relatively two easy years now upcoming, you would think that Xerox would be making hay whilst the sun shines. They'll be building the cash position. They'll be looking at the 2028 and 2029 maturities, perhaps forward paying them or even renegotiating them now. Nothing's been given in the way of guidance just yet. We're expected to receive guidance in tomorrow's earnings. That's the Q4 2025 earnings. But a conservative free cash flow estimate through an AI, right? You're looking at 250 million. An optimistic free cash flow estimate is 450. Now that gives us a medium of over 300 million. To be honest, I expect more than 300 million for free cash flow as a projection. I expect them to give us much better guidance than that. Obviously, none of this is investment advice, it's all for entertainment purposes. Seek professional advice before you purchase any securities. Now, I'm looking forward to the earnings release that's coming through tomorrow. Right, there's a scheduled earnings call that I'll be keeping tabs on. Like and subscribe, please, people. Like and subscribe. Thank you.